All right, let's look at exercise 10.4, dealing with a profit center responsibility report. So River Lions Corporation deals with fitness equipment. They have a decentralized organizational structure separated by business function. One of the segments is classified as a profit center. For fiscal year 2017, River Lions have budgeted sales for the profit center of 2.5 million. To generate these sales, we expect the profit center to incur cost of goods sold of 1.5 million, variable selling and admin expenses of 200,000, and fixed selling and admin expenses of $100,000. Actual results for fiscal year 2017 for the profit center were as follows. So we can see actual sales were 2.25 million. Cost of goods sold was 1.55 million. Variable selling and admin was actually 227,000, and fixed selling and admin was 100,000. So based off of this information, we can prepare a profit center responsibility report. Again, starting with the heading, name of the company, River Lions Corp. Name of the report, profit center responsibility report, and then the reporting period, in this case for the year ended December 31st of 2017. We're going to have a column for each item for the budgeted amount, for the actual amount, and then a column for the variance. And we're setting this up as a gross profit income statement, essentially. This should be very familiar from your financial reporting course. Gross profit income statement starts with sales, less cost of goods sold, gets you to gross profit, less your other operating expenses gets you to, in this case, controllable margin. So that last line is a little different, just because not all the costs that a company as a whole are going to occur are going to be showing up on the responsibility report. It's just what the profit center is in charge of. In this case, they're in charge or have control over sales. They have control over cost of goods sold, and then they have control over the selling and admin, both variable and the controllable fixed component. So that's what's represented here. So for sales, they had budgeted 2.5 million in sales. They only made 2,250,000 in sales. So there is a variance here. If you subtract the two, you get a variance of 250,000. And notice it's labeled unfavorable. With sales, remember, if actual is less than budgeted, that variance is going to be labeled as unfavorable because we didn't sell as much as we anticipated. Therefore, we came in under that. So therefore, that's why we label it as an unfavorable variance. Expenses work the opposite. If actual is greater than budgeted, then that's labeled unfavorable. So it works a little different depending on if it's a revenue item or an expense item. So that's a little trick to keep in mind. Cost of goods sold, we anticipated to spend 1.5 million. We actually spent 1.55 million. So we overspent by 50,000. So that's going to be a $50,000 unfavorable variance. Meaning our gross profit, we had anticipated to generate a gross profit of $1 million. We only generated a gross profit of 700,000. So we were under budget by 300,000. And again, you can think of gross profit, we want it to be as high as possible. So if our actual gross profit was less than budgeted, we're going to label that $300,000 variance as unfavorable. Now looking at our selling and administrative expenses, our variable selling and admin expenses, we had anticipated to spend 200,000. We actually spent 227,000. So we overspent by 27,000. So we're going to label that variance as unfavorable. Controllable fixed costs, however, we came in on budget. We anticipated to spend 100,000. We actually spent 100,000. So there is no variance there. And that makes sense. Like fixed costs, you have more cost certainty over. You can better anticipate what they're going to be because they are fixed in nature. They don't really change. So that makes total sense why we don't have a variance there. Total selling and admin, we anticipated to spend 300,000. Again, that's the sum of variable and the controllable fixed component. We actually spent 327,000, which again is the combination of the variable selling and admin and the controllable fixed component. So again, we overspent by 27,000. So that's going to be an unfavorable variance. And again, that all of that 27,000 variance with respect to selling and admin came from the variable component. In conclusion, We anticipated to have a controllable margin. So essentially, the profit for this center, we expected to have a profit of 700,000. The gross profit of 100 less the anticipated selling in and in of 300. We anticipated to have a gross profit, or sorry, a profit or controllable margin of 700,000. We only ended up turning a profit or a controllable margin in this center of 373,000. So we were off by quite a bit. That difference between the two gets us our variance of 327,000, and that would be an unfavorable variance. So, if the whole point of these reports is to analyze how well or not so well a division is doing, in this case, we missed our goal of 700,000 by almost 50%. I would say that's a very large discrepancy there. And that would be cause for concern if I'm the executive that's analyzing this profit center's performance. I would have a lot of questions. And again, doing this report shows me, okay, what are the biggest areas that caused this $327,000 unfavorable variance for controllable margin? If you look down this column, clearly we can see the biggest contributor was we missed sales. So then we would start to ask ourselves, why did we miss sales? Is our product, we're not doing enough marketing? Is our product not as good? Is it not being accepted by our customers as much as we anticipated? What's wrong with the product? These are questions that we can start to answer and investigate. And then hopefully going forward, we eliminate this variance in future periods. But again, doing this kind of report gives me enough information to start making those investigations, start asking those questions so we can change operational decision making going forward.